Let's talk about government assets that actually make money, like state-owned power plants, public universities charging tuition, or city toll roads. These are cash-generating assets, and their value can drop for reasons beyond normal wear and tear. If a government asset loses value, say, a new technology makes a power station less profitable, that's called impairment. Ignoring impairment misleads the public about the government's true financial health. That's why we need clear, standardized rules for reporting asset values. Without them, comparing financial performance across public entities would be impossible. Enter Ipsas 26, the official rulebook for handling impairment of cash-generating assets in the public sector. It ensures assets aren't carried at more than their recoverable amount, promoting honest, transparent reporting. Ipsas 26 is essential for financial discipline and public trust. Ipsas 26 sets the procedures for making sure cash-generating assets are not overvalued on public sector balance sheets. It applies to any public entity using Ipsas and covers assets held mainly to make money, like public transport systems or municipal parking garages. Non-cash generating assets, like public hospitals, are covered by a different standard, Ipsas 21. Ipsas 26 excludes assets already covered by other standards, such as inventories or financial investments. The standard is applied at the end of each reporting period, usually year-end. Entities look for signs, called indicators, that an asset's value may have dropped. If there's a red flag, a formal impairment test is required. Some assets, like those with indefinite useful lives, must be tested every year, even without indicators. The goal: keep reported asset values realistic and up-to-date. You don't test for impairment randomly. Ipsas 26 gives you clues to watch for. External indicators include big drops in market value, new competition, legal changes, or technological advances that hurt the asset's earning power. Internal indicators might be physical damage, changes in how the asset is used, or poor financial performance. If you spot any of these, it's time for a formal impairment test. Management must use judgment. This list isn't exhaustive. The absence of indicators doesn't always mean an asset is fine, especially for those requiring annual tests. The key is vigilance. Financial statements should reflect economic reality. Regularly scanning for impairment ensures assets aren't overstated. This process protects transparency and accountability. It's about telling the real story behind the numbers. If an indicator is found, it's time to crunch the numbers. Compare the asset's carrying amount, book value, to its recoverable amount. The recoverable amount is the higher of fair value, less costs of disposal, or value in use, the present value of future cash flows. If the carrying amount is higher, the difference is the impairment loss. For example, a bus fleet's book value is $2 million, but after a new subway opens, its recoverable amount drops to $1.2 million. The impairment loss is $800,000, which must be recognized immediately. The new carrying amount is $1.2 million. The loss is recorded as an expense, reducing the asset's value on the balance sheet. This process ensures assets reflect their true economic worth. Accurate impairment calculations keep financial statements honest. Sometimes, an asset's value bounces back. Ipsas 26 allows reversal of impairment losses if there's evidence the asset has recovered. Look for positive indicators, rising market value, improved performance, or favorable changes in the environment. If the recoverable amount now exceeds the carrying amount, reverse the impairment, but only up to what the asset's value would have been without the original loss. For example, if the bus fleet's value rises to $1.6 million after subway disruptions, you can reverse $400,000 of the previous loss. The reversal is recorded as a reduction in expenses. This prevents overstatement. Reversals can't push the asset's value above its original depreciated cost. Regular reassessment ensures asset values stay accurate. It's about reflecting both losses and recoveries fairly. Transparency is crucial. When impairment losses or reversals happen, entities must explain them in the financial statement notes. Disclose what triggered the change, the amount, and where it appears in the income statement. Describe the affected asset or unit, and state whether the recoverable amount was based on fair value or value in use. If fair value is used, explain how it was measured. If value in use, disclose the discount rate. Remember, Ipsas 26 is for cash-generating assets, those meant to make money. Non-cash generating assets, like schools or hospitals, follow Ipsas 21, which uses a different impairment approach. The process for cash-generating assets focuses on future cash flows. For non-cash generating, it's about service potential. To comply, identify cash-generating assets, check for impairment indicators, calculate recoverable amounts, record losses or reversals, and disclose everything clearly. Following these steps ensures accountability and builds public trust. Ipsas 26 keeps public sector financial reporting honest and reliable.